Ever found yourself scratching your head and wondering if there's a way to legally keep more of your hard-earned cash? Well, you're in the right place. Today, we're taking a deep dive into the world of income tax, breaking it down in plain, everyday language. Get ready for a roller coaster ride of stats, facts, real-life examples, and some solid advice to help you pay less tax. Disclaimer: this is not tax advice. It's only for educational purposes. If you need tax advice, you need to consult a pro where you live. Understanding income tax might seem like navigating a maze, but I'll break it down in plain English. There are three things you need to understand: tax brackets, deductions, and tax credits. I'll talk about tax credits much later, but first, what's the deal with tax brackets? Well, it's like a staircase, with each step representing a range of income. The higher you climb, the higher your tax rate. In 2022, for instance, if your income is in a certain range, your tax rate is a specific percentage. The higher you climb, the higher your tax rate. If you make up to $10,275, you're in the 10% bracket. From $10,275 to $41,775, it's 12%, and so on. Keep in mind that tax structures may vary in different countries. The example provided is based on the US tax system. Now, let's talk about deductions. Think of them as tax magic tricks. They're expenses that can lower your taxable income. In 2022, the standard deduction for individuals is $12,950. This means if you have deductions like mortgage interest, medical expenses, or charitable donations that add up to more than $12,950, which is the standard deduction, you'll save on taxes. Tax laws differ worldwide, and the deductions mentioned may not be applicable in your country. Consult with a local tax professional for accurate information. Your filing status, like single, married, or jointly, determines which tax brackets and deductions apply to you. It's important to choose the right one, as it can have a big impact on your final tax bill. So, how do you calculate your tax? Report your income, deductions, and credits on a form called a tax return. This is where you do the maths to figure out how much you owe or if you're due a refund. There are different forms for different situations, but it is 1040 for most individuals. Form 1040, also known as the U.S. Individual Income Tax Return, is the standard document individuals use to file their annual income tax returns with the Internal Revenue Service, IRS. It's a comprehensive form that allows you to report various types of income, claim deductions and credits, and calculate the amount of tax you owe or the refund you're entitled to. Legal tips and tricks to help you pay less tax. 1. Start up your startup. Having a side business is like having a secret weapon for tax savings. You see, when you're running a legit business, you can deduct a bunch of expenses from your income. And one of the big wins? Health insurance premiums. Yep, you can snag deductions if you meet the special requirements. Oh, and if you follow the IRS playbook, you might even score with the home office deduction. That means a chunk of your home expenses, think utilities and internet, can be written off. Now, here's the thing. To grab these deductions, you've got to be in it to win it, meaning your side gig needs to be aiming for profit. The IRS has its checklist in Publication 535, so make sure you're ticking those boxes. And hey, if you've been raking in profits in 3 of the last 5 years, you're pretty much a tax-saving superstar in the eyes of the IRS. So if you're rocking a side hustle, make sure you're getting all the tax breaks you deserve. 2. Invest smartly. Okay, let's talk about municipal bonds. Municipal bonds, often referred to as munis, are debt securities issued by local or regional governments worldwide or their agencies to fund various public projects. These projects can range from building schools, highways, water treatment plants, and other essential infrastructure. When you invest in a municipal bond, you're essentially providing financial support to the issuing government entity. In return, they commit to making periodic interest payments, and upon the bond's maturity, you receive your initial investment back. Think of it as contributing to the betterment of your local or regional community. You're lending them money for a specified period, and, in appreciation, they compensate you with interest. Now here's the exciting part. The interest you earn from municipal bonds is often tax-free at the federal level, and depending on your location, it might also be tax-exempt locally. That's a win for your wallet, no matter where you are. Moreover, these bonds boast a solid historical track record. Studies indicate that they typically have lower default rates compared to corporate bonds. We're talking 0.1% for municipal bonds versus 2.25% for major global companies. Sure, they might offer lower interest rates compared to other investment options, but when you factor in the tax benefits, they start looking pretty attractive. Remember, the higher your tax bracket, the more appealing they become. It's all about finding the right fit for your global financial game plan. 3. Declutter your portfolio. If you've got some underperforming stocks dragging down your investments, here's a silver lining. Selling them might actually save you some money come tax time. When you sell a stock at a loss, you can use that loss to offset any taxable gains you've made elsewhere. It's like a financial balancing act. For individuals, the limit on this offset is $3,000, or $1,500 if you're married and filing separately. But here's a word to the wise. Don't let tax strategies lead your investment decisions. Only sell a stock if it genuinely doesn't align with your portfolio anymore. It's not about the tax break alone. Plus, if you decide to repurchase that same stock within 30 days, there are some rules you'll want to keep in mind. If you sell a stock at a loss and then buy it back within 30 days, it's considered a wash sale by the IRS. In this case, you won't be able to claim the loss on your taxes. To avoid a wash sale, you can either 1. Wait at least 31 days before repurchasing the same stock. 2. Purchase a similar but not identical investment to the one you sold. This way, you maintain exposure to the market without triggering a wash sale. Keep in mind that tax laws can be complex and subject to change, so it's always a good idea to consult with a tax professional for personalized advice. 4. Health is wealth. If you're on a high-deductible health insurance plan, you've got a neat trick up your sleeve called a health savings account, or HSA. Just like a 401k, any contributions you make through payroll deduction, and your employer might even match them, won't be counted as taxable income. And guess what? If you make direct contributions, they're 100% tax deductible. You could stash away up to $3,850 if it's just for you, or $7,750 for a family. That's a bump up from last year. And here's the real kicker. That money can grow tax-free. Plus, when you use it for qualified medical expenses, no taxes to worry about either. Now, if you've had a stint in the hospital or some pricey dental work, keep those receipts handy. For the 2023 tax year, you can deduct medical expenses that go beyond 7.5% of your adjusted gross income. Let's say your income's around $40,000. Anything over $3,000 in medical bills could be deductible. So if you had $10,000 in expenses, you could potentially deduct $7,000. Sounds like a good deal to me. 5. Start preparing for retirement now. Retirement is not as far off as it seems. One super smart way to save on taxes is by socking away money into your retirement account. As Craig Ferrantino, the president of Craig James Financial Services, puts it, that's an excellent opportunity to reduce taxable income. Here's the scoop. If you contribute to a traditional 401k or IRA, you can actually subtract that amount from your taxable income. That means less federal tax on your plate. Plus, the cash you stash away gets to grow tax-free until you're ready to kick back and enjoy your retirement. Now, there's also something called a Roth account. You use after-tax dollars to fund it, so no tax deduction up front. But here's the sweet part. The money grows tax-free, and when retirement rolls around, you can dip into it without paying a cent in taxes. And if you're wondering about deadlines, you've got a bit of wiggle room. You've got until the tax filing deadline to make tax-deductible contributions to traditional IRAs. So no need to rush. Just make sure you've got a plan in motion. 6. Start enjoying retirement now. You could start preparing for your retirement now, but you don't need to wait until you retire to enjoy the benefits. You can stash away up to $22,500 in a 401k or 403b plan, up to $20,500 in 2022. And if you're rocking the big 5-0, you can tack on an extra $7,500, up from $6,500 last year, to your workplace retirement plan. Here's the math magic. Say you're pulling in $100,000 this year. If you max out your 401k contributions, you'll only be taxed on $77,500. That's a pretty sweet deal, right? But what if you don't have a workplace plan? No worries. You can still score tax savings by stashing up to $6,500, $7,500 if you're 50 or older, in a traditional individual retirement account, IRA. Depending on your income and whether you or your spouse have a workplace retirement plan, you might be able to deduct some or all of your IRA contributions from your taxable income. Now, keep in mind that there are some income limits and rules to play by, but that's where we've got your back. So, get those retirement accounts fired up and start building that financial future you've been dreaming of. 7. Timing. Timing is everything when it comes to taxes. Here's a little tax hack for you. There's a big difference between doing something on December 31st and waiting until the next day. If you've got a deductible expense on the horizon, consider if you can swing it this year instead of next. For example, paying your January mortgage in December could score you an extra month's worth of interest to deduct. And if you're teetering on the edge of that medical expense deduction threshold, bumping up that root canal might just ease the pain a bit, especially if it suddenly becomes deductible. 8. Give. Guess what? Your generosity can actually earn you some tax brownie points. And get this, it's not just about cash. If you've handed over clothes, food, old sports gear, or household goodies to a legit charity and got a receipt, you're in the tax-saving game. In 2023, if you're into itemizing deductions, as opposed to the standard route, you could potentially write off anywhere from 20% to a whopping 60% of your adjusted gross income for your charitable acts. That's pretty cool, right? And here's a handy tip. Some tax software tools have nifty features that help you estimate the value of each item you donate. So, before you drop off that bag of goodies at your local charity, take note. Those little acts of kindness can add up to some serious deductions. 9. Write off business travel expenses even while on vacation. Ever thought about combining a work trip with a little vacation? It's not just a smart move for your schedule, but also for your wallet. You can actually deduct a portion of your expenses that went towards business-related stuff. Think airfare and a chunk of your hotel bill based on the time spent on work-related activities. Now, a word of advice from the wise. Keep it legit. Trying to write off expenses that aren't really business-related can lead to a not-so-fun run-in with the IRS. So, keep it real, and if you're unsure about the calculations, it's always a good idea to chat with a tax pro. They always know better. 10. Claim your tax credits. Absolutely, let's dive into the world of tax credits. Claiming tax credits is like finding hidden treasure in the tax world. These are like little rewards from Uncle Sam for certain expenses or situations. They can significantly reduce your tax bill or even put money back in your pocket. For instance, there's the child tax credit, which gives parents a break for each qualifying child. Then there's the earned income tax credit, which can be a substantial boost for low to moderate income individuals and families. Education credits are a game changer for students or parents supporting them. They can offset some of the costs of higher education. And let's not forget about the renewable energy credits for those who've invested in eco-friendly upgrades for their homes. It's worth taking the time to explore all the available tax credits that may apply to your situation. They're like little financial gifts waiting to be claimed. Remember, tax laws can be a bit of a maze, so it's always a good idea to consult a tax professional or use reliable tax software to make sure you're getting all the credits you're entitled to. Happy tax saving! There you have it, valuable tax saving tips and tricks. I hope you found them helpful. If yes, hit that subscribe button and click to see another video like this one that would help your financial literacy. Thank you for watching this video. See you in the next one.